The company is called LSI Industries. The ticker is LYTS. It's a $19 stock today, and they have a very unique business in the U.S. When you go into a convenience store, or you go into a gas station, or you go into a Pep Boys, you see lots of, or even a Whole Foods, you see lots of display systems and graphics packages and lighting and customized serving equipment to get your slushy or your coffee or your hot bagel that's been pre-packaged at the counter or the counter itself. And that's what they do. They make all this neat stuff that is not going to be affected by AI or by China, because China doesn't have this business. So it's a company that is basically rolling up the the specialty retail outlet, capital equipment business in a way, because that's how these guys create their revenues. They display and sell food products or petroleum products, or those kinds of specialty retail outlets, and they make the lighting, they make the boards, the electronic menu boards at the McDonald's, those kinds of things. So it's a niche business, but it's a very large business. And there's not a publicly traded company that's ever really gotten involved in this in a major way. It's a lot of private companies, a lot of family companies, a lot of $50 and $100 million businesses. And these guys are going for the global roll up play, where their customers, the Exxons and the Wawas, they don't want to deal with 13 vendors to assemble one of these outlets or refurbish one of these stores. So these guys are trying to accumulate all the pieces in a convenience store, from lighting to checkout to display to packaging these products. And they want to sort of go from a few $100 million company a few years ago to $1 billion company in the next couple of years. So they culminated these ambitions with a transformative acquisition of a $300 million company in the last couple of weeks. So they're already an $850 to $900 million run rate business. It's very accretive. The company probably should add 25 cents or so to earnings in the first full year it's underneath Lights' wing. So Lights' estimates were $1 and maybe $1.20 for next year. They're on a June year, so they're close to finishing up this year at $1 EPS. So when you see the PE, it looks like it's mid-teens. But for fiscal 27, I would probably be closer to $1.20 to $1.25, and then $1.50 in fiscal 28. And fiscal 28 is next year right now, and or not right now, but in 4 months it's next year, because fiscal 27 is in June. So here you have a company with a defendable niche, a moat around their business, big margin expansion, lots of inorganic sales growth, but they've been growing organically 8-10%, which is still pretty impressive in today's world for companies that make hardware products and not technology, not semiconductor or data center products. So, this company in the past has traded 20, 25 times earnings for periods. It's a very high quality management, and they inspire lots of confidence with their story for secular growth opportunities. So if these guys ended up making $1.50, it could easily be a $25 or $30 stock again. Now, I try to shoot for doubles and triples, as you guys know, Charlie. I'm swinging for the fences, and occasionally I strike out and take.
You've been good. You've been very good at this.
Yeah. I have my stingers too. I've had a couple of stingers, so I'm generally a high risk, high reward type of guy. And if you're right, you get 2, 3, 4 times your money. This isn't one of those names. This is not a Robert Marson typical $3 stock that goes to 12. If I'm right, it's a solid double over 2 to 3 years, but it's a more mundane business, and the stock is not cheap enough to 3x. And the first time I bought it at 6. I sold it at 13, and I watched it double after that. That was pretty painful, but I'm hoping now that in Charlie's correction, that it can get back down to 15 or 16, because then that would, give me much better visibility to a double back to 30 at least as we come out of it. But
Robert,
uh,
Robert, if I can just interrupt for one, how is this? First of all, give me the symbol again. But how is this stock held up? Because the small caps really had, came out of the starting gates at the beginning of the year really strong, but I think they've given up some of their gains. Has this stock held up, or is it traded with small caps in
it's
general?
the ticker's LYTS, and it had a big run into last year, and it got overvalued. It got to 25 when the year estimate was only $1, and that's too much for me. And that's why I had sold the stock even way earlier than that, in the mid-teens, the low to mid-teens. So I thought it was way overdone. But I said if it ever came back and got cheap again, I would want to buy it back. And it's been fading since the last quarter, which the numbers were great and the outlook wasn't particularly great for the business. It was good, but when you're at 25 times earnings, you're pricing in great. So the outlook for the core business is still good, solid, but the acquisition is going to be significantly accretive. And because management needs to put together a new 3-year game plan, nobody on the street is publishing the new numbers. And my number, would be, as I said, $1.40, $1.50 for the year that starts in a few months. And if the stock, which today has come down from 25 to 19, Charlie, gets down to 15 or 16, we could be buying this at 10 times earnings, 11 times earnings. And in a market that's still in the low 20 PE ratios, and the market's 20 something times earnings and 3+ times sales. This would be 1 time sales or under 1 time sales and about 10 to 12 times earnings. So that's really where my interest is. So I nibbled at it this week, and I would eat much more significantly if it pulls back in a correction about a 15%, further decline. The entry points, the reason my formula works is because I'm very sticky about my buy for process, and that buy process requires a significant bear market in a stock before buying it. So Bakesy hates my charts because they look crappy all the time. The stocks are always down a lot. So this doesn't qualify as down a lot. But at 15 from 25, I'd say that qualifies as down a lot. So I'm waiting for it to get into the position that I really like my entry points to be down a lot. And I mean 30, 40, 50%, not down. I'm not buying no 5 or 8% dip because it's dip, buy the dip. You
Yeah.
know, I want a nasty bear market in the stocks before I consider buying it, because, if you go down 50%, you actually 2 years later, you retrace that loss, you have 100% gain. And that's my stickler is not just buying momentum and 52-week highs and great charts. I think anybody could pile onto a hot trade. That doesn't take a lot. It's finding, the babies that are being thrown out with the bathwater at the 52-week lows and are cheap. And that requires a bear market or a correction for all the good companies to get, better entry points. Right now, a lot of good companies are at the high end of the range and are expensive. And I've been selling a lot, and I've been on the show, and I've been posting, in our chat, that I've been raising cash across the board. I mentioned that I did this study a few weeks ago in my own portfolio, forced to trade in each stock in my portfolio, buy or sell, no hold option, that I would have sold 3/4 of my long book back in February. And that's a scary thing to think about. So I had to start selling across the board and trimming across the board. And so I'm not, pounding the table to buy lots of stocks here, but I did nibble at LYTS, and I hope I'm way too early and I get to buy it 20%, 15%, 20% cheaper. And if we get a general correction in the stock market, Charlie, there's not a lot of liquidity in these small cap names. So I'm sure it'll come my way and I'll be able to establish a real position.
Well, I share your